Hey everybody, this is Pat Jennings again from thebizseller.com, and this is the next video in our series of frequently asked questions about business valuation. In fact, the most frequently asked questions. And the question that we're going to answer in this video is, how does the value of the items on your balance sheet affect the valuation if you're using a multiple of earnings valuation method? And if you don't know what I mean when I say a multiple of earnings valuation method, you can click on this link here to watch a video that explains the multiple of earnings method. But from this point forward, I'll assume that you understand that phrase, multiple of earnings. Now, the thing to keep in mind when you're doing a multiple of earnings valuation, the thing to keep in mind as it relates to the balance sheet is that the earnings that you registered, say, for the past year, and the multiple that you're applying to it, both reflect already the value of the things on the balance sheet. So let's say that you have a business in which you earned $100,000 last year, and you are going to apply a multiple of 2 to that to come up with an asking price of $200,000. So the question is, then what do you do with the things on the balance sheet that individually have their own worth? And specifically, we're talking about things like inventory, machinery, vehicles, other equipment and computers, accounts receivable, and the cash on hand. Well, basically we can break these into 3 different items. And the first one is the things you used on a daily basis to create those earnings, like your vehicles, your equipment, your machinery. Your location is something that's of value that would be reflected in the price. The amount of repeat business that you have, your experienced and committed employees. Well, all of these things were necessary in order for you to generate that $100,000 in earnings. And so if you're using a $100,000 earnings times a multiple of 2 to get to $200,000, the value of these items is already reflected in the earnings and in the multiple. Now, if you have especially good employees or an especially good location with a great lease, if you have an unusual amount of repeat business, you could reflect those sorts of assets in the asking price by raising your multiple. But what you can't do is use a multiple of earnings and then take each one of these items and apply a value to it and add that on top of it. That would be called an asset-based valuation, where you take each of your assets and you assign them a value, you add them up, and that's how you come to your asking price. But if you use a multiple of earnings valuation method, and then you add on top of that the asset-based valuation number, well, you're double dipping. You're charging them for the business in 2 different ways, and no one's going to pay that price. So in our example, $100,000 in earnings last year times a multiple of 2, that $200,000 asking price has the value of your equipment, your machinery, your employees, and your location built into it. And if you think that that's not fair to you because those things are especially valuable, then you might want to increase your multiple. Now, for the other items on the balance sheet, the cash on hand and the accounts receivable, well, I suggest that you just take those things with you. There's no reason for you to turn over the cash that you have on hand to the new owner. They should provide their own working capital. And as well, the accounts receivable. That's money that you're owed for goods and services you've already delivered. So you should sell the business free and clear, meaning they take over the business, you take the cash and the accounts receivable, the income that's already been earned, with you. And since the buyer isn't taking that cash or accounts receivable, it really has no impact on the selling price. Lastly, we have inventory, and this is an important individual item, particularly if you're in a wholesale business or a retail business where the value of the inventory is very high and it's always being turned over. So it's in a separate category from, say, your fleet of vehicles or your machinery or your computers. In most cases, the inventory is valued at its replacement cost, not at what the seller paid for it, and not what it can be retailed for, but what it would cost the new owner to go out and replace that inventory. So particularly in retail and wholesale businesses, even if you're using a multiple of earnings method, you do want to set a date where you would go through the inventory and establish the value of that inventory, the replacement value of that inventory, and you would add that to the multiple of earnings number. So that is the one item that you would add on top, specifically if you're in a business that's very centered around inventory and it's always turning over, because if you sell your business 2 months from today, how do we know the exact value of the inventory when the buyer actually takes over? So that's the one item that you would add on top of the multiple of earnings. Now, if you found any of this helpful, you can click the subscribe button in the upper left-hand corner, or you can click the like button in the lower left-hand corner. If you have a question about your business or about valuing your business, or if you just have a more general question about the sale of your business, you can leave a comment or a question below, and we will address commonly asked questions in future videos. And speaking of which, I will talk to you in the next video.